There's a lot of ways to skin a cat. There's a lot of ways to make money in the hard money business. Phil is on the other side of the table. I've known Phil for a lot of years. He's actually a neighbor of mine. We met by Phil coming to one of the events. And he hasn't missed one. He even goes out to Florida with us. He hasn't missed an event. We actually think he's part of the actual team itself. Phil has, I think, I could be wrong, but if it's not the largest, it's certainly one of the largest commercial loan workout companies in the country. He's been very, very successful. Phil recently paid a broker $75,000 commission to bring him a loan workout deal. $75,000. So he's actually on another table, right? He's on a whole different table. How many people here know of real estate project that's upside down? Huh? If so, give me a yes. Yeah. Okay. Everybody knows about a building, a property that's upside down, whether it be a golf course, a commercial building, a nursing home, a self-storage, whatever it may be, it's upside down. And they need to do a loan workout to get rid of the personal guarantees, to lower the interest rates, to whatever whatever is needed. Phil has a team of attorneys and real estate agents and brokers and all economists and all kinds of, and they put together a package, and they're very, very successful. It is another huge revenue stream for you. It's not a long presentation, but you've got to listen to it because it's powerful. When you pay out $75,000 to somebody, that has my attention. That's a lot of money. Considering the fact that there's something like $1.3 trillion that's coming due in debt that can't be refinanced through traditional means, do you think for a second that there's a market there? I mean, if you just didn't even go looking for this kind of business, it's probably sitting on your desk right now. So Phil Gemmett is going to educate us in terms of what is a commercial loan workout, how does it function, and also how can everyone benefit, including the bank, including the borrower, and also including you. Let's have a big hand for Mr. Phil Gemmett, Breakwater Equity Partners.
Good afternoon, ladies and gentlemen. Are we a little hungry out there? Okay, lunchtime's coming up. And I know when I went to class and the teacher finished early, I liked that teacher. So I'm going to promise you that I'll finish a little early today and we can go to lunch, but I want to maximize the time with you and share some thoughts on how you can take advantage of commercial workouts. Now, when I use that term, commercial workout, is that positive or negative? It's negative for most people. It's something. It's like going to the doctor. If I use the term needle, what does that inspire in you? Sort of negative, right? But not to everybody. What about the nurse? When she thinks of the term needle, she thinks, well, I give needles, that's how I put food on the table, and the doctor's thinking, well, a needle means I put $25 in my pocket every time somebody gets one, so he's pretty positive about it. So I think it's an opportunity. When you think about the term commercial workout, you can be like the doctor and the nurse. You can think there's opportunity there when it comes to that. So what are people looking for? Let me see if I can move this along. Okay, one more. What are people looking for when they come to us for a commercial workout? And I want to give them to you in the order that they come. They're looking, number one, to get off the personal guarantee. We had a client, or a potential client actually, in this week, and we were talking to him, and he has $60 million of cash in this deal that we were talking about, as well as a humongous loan on it. And all he cared about was getting out of the personal guarantee. And that's what we find with clients. That's their number one commitment. Get me off that guarantee. And there are a number of defenses for that, and we've been very successful at getting clients off the personal guarantee. The second thing that clients are looking for is to get a reduction in the principal. Obviously, everybody would like that. We have a deal with a bank right now that we've been working on for 12 months. And generally, when I talk to a client, I say, you know, you have to be patient. This is a long-term process. These things don't happen quickly. 12 months is a pretty typical time frame. And this is a $32 million loan that we're getting a $9 million cram down on. And that $9 million takes it from an uneconomic position to a long-term opportunity for those clients. And when they came to us, they were 30 days away from losing this property in a sale. So that's the second thing, getting a principal reduction. The third thing, and I'm not using this clicker right because we're not, let me catch. Okay, now we're ahead of ourselves. The third thing is getting an interest rate reduction. And when we look at getting an interest rate reduction, we want to get an interest rate reduction that makes sense. Because it's no use having a loan where, let's say you're paying 6%, and you negotiate with the bank and you get it down to 4%, and you think, okay, you know, got 2% off, 33% reduction, that's pretty good. But if you need to get down to 2%, so you don't have any negative cash flow on a monthly basis, then that's what we need to target for. And so we look at what the property needs to target in terms of the interest rate, and we'll negotiate on that basis. But that's the next one. And then the next one is the extension of the term. It says terms there, but extension of the term. And that's an important one. But it's also a very tricky one a lot of the time. If you're dealing with a bank and it's a bank loan, you're free to negotiate with them in terms of the term. They have lots of flexibility. But if it's a CMBS loan, like a commercial mortgage-backed security, much more complicated because the rules and the regulations are very restrictive. And so you'll often find that you can only get 1, 2, maybe sometimes 3 years extension in that term. And what we're looking for is working with a client to get a term extension so that they're through their problem period. Because we see it so often that they'll get a 6-month extension or even a 12-month extension, and they face the same problem coming up in 6 or 12 months. And they've given away all their cards at the previous negotiations. And so when we sit down with the bank, we want to make sure we negotiate a term extension that makes sense. Then the next one is minimizing tax exposure. And it's surprising to us when clients come to us how many of them are unaware of the significant consequences of the tax issue. Forgiveness of debt. You know, if you get a reduction in the principal from 20 million or 32 million in that case down to 23 million, you've got to structure it in a way so that you don't trigger tax consequences, and there's ways of doing it. Because Uncle Sam's out there and he's looking at you and saying, well, you know, you've depreciated the property over, you know, a significant period of time. You took all those deductions for the interest that you paid, so there's recapture. And Uncle Sam wants a check right away, and so you have to be very careful about the tax implications of restructuring. And then the last thing is clearing out non-performing assets. We have people that come to us, they have portfolios, most of it is healthy, they have a couple of troubled assets, get those out of the portfolio. And then preservation of equity. But moving on because of time commitments, where do clients go when they get into trouble? And this is one of the challenges. You know, we find that we ask that question to our clients, and the natural thing when you get into trouble, you're going to go to a lawyer. And we think if a lawyer is a bankruptcy lawyer, then what's he going to suggest? You know, let's work this out via bankruptcy. Or if he's a litigator, he's going to say, let's work this out via litigation. And we have lawyers on our team, and understanding the law is critical, but it's much broader than that. And so we find that people go to their broker, the financial person that got them into this, or worst of all, their brother-in-law to get advice. And our suggestion is, as in any area, you have to go to a professional who has knowledge and experience, and to get the help there. So when we look at it, and this is what I want to go through, and then we can wrap it up quickly after that. We've done well over $1 billion since the beginning of 2010. We looked it up. We've done about $1.5 billion. We've taken in. We're either currently working on or have worked through. And we would say there are 4 things that you need to have knowledge and experience in to have a successful workout. And I'll line those out, and then I'll go through them real quickly. And the first one, it's the third one down there, you have to have knowledge and experience in terms of the bank itself. And we find that most people miss this. They get all their facts and figures together, they go and sit down with the institution, and they know nothing about the institution. You don't do that when you go to war. You know what the other side is about, right? You know how strong they are, what the requirements are. And we say the same thing when you go to negotiate with the financial institution. You have to know the rules and the regulations that they're obligated to abide by. You have to know their documentation process, and you have to know the health of the institution, because each of those things can be a leverage point, and ultimately that's what you're looking for, leverage points. And so let's look at, for example, rules and regulations. There's a lot of financial institutions operating under government restrictions. And if you know what those restrictions are, you see how they affect your client, and it can be a leverage point for your client. Building a wall of defense. And when you build a wall, you build it a brick at a time. And so the documentation can be 2 or 3 or 4 or 5 bricks in that wall, and that's the way we look at it. And then looking at the health of the bank. And if it's a weak institution, then they can't afford to negotiate in good faith. They're going to be that zombie bank, the extend and pretend. And if we know that in advance, we're going to design a workout strategy with that in mind. If, on the other hand, they're strong, they're healthy, we know they can negotiate with good faith, we're going to have an entirely different strategy. So knowing the bank up front is key. The second one is understanding the law. And the law as it relates to personal guarantees, bankruptcy, and litigation. And we already talked a little bit about personal guarantees. So talking about bankruptcy, and that's a negative term for most people. And what we do is we simulate for the lender what a bankruptcy is going to look like. And we say to the lender, this is a very expensive proposition. You lose control of the asset. The judge is making the decision. Is this something you want to go through? Let's negotiate instead of going through bankruptcy. And the same with litigation. We lay it out in terms of contract issues or tort issues, things that should have been done or could have been done that provide liability for the lender. And we lay it out and say, do we want to litigate? Or do we want to negotiate? And in most of the cases, we find that we're able to just negotiate our way through with the lender. But we don't believe in making idle threats. You have to be willing to go through. And so if the lender won't listen, as I gave the example before, you have to put the entity into bankruptcy. And if they won't listen in terms of litigation, you have to file litigation. And we can demonstrate to the lenders that we have many clients in bankruptcy and or litigation, and so it's not an idle threat. And so that's the second area that you have to have knowledge and experience in, the law. And the third area is the one that people come to first, and that's the economics. People think, if I understand the economics of this real estate, then I can negotiate my way through. We have a saying in our office, bad is good. Because you're so used to when you go to a bank, you want to put your best foot forward. You want to say, the building is, you want to give it the highest possible valuation, right? Or if you're talking about lease rates, you're talking about how they're sort of stabilized and they're going to go up. We sort of have the opposite approach. We say things are, pretty bad at the moment and they could get horribly worse. And so we go in and we have a property that they paid $35 million for. They got a $25 million loan on it. The bank thinks it's worth $20 million. and we say we think it's worth 10. And being able to credibly defend that $10 million position and credibly pick apart their $20 million position. And so that's the way we approach it in terms of the economics. And the last area that you have to have knowledge and experience in is finance, because these are complicated situations. When clients come to us, it's very rarely a single asset and a single investor. And so you have investors that, multiple investors, some who rolled in through a 1031 exchange, some who made a direct investment. And you have to be able to model this out so that it works for the bank, it works for the asset, and it works for the multiple investors in that with different objectives. And so it's a very complicated modeling that you have to go through. And so all of those things come together when you're working out doing a workout for a client. And the way we approach it, we have a two-phase approach. The first phase is relatively quick. It's like 3 to 4 weeks. And we take in all the information relating to the client and the deal. And then we have 3 teams. We have a banking team, a finance team, and a legal team. And they go through and they look at the strengths and the weaknesses of the deal, and it's out of that strength and weaknesses that they're going to carve a workout strategy. And then the objective of phase 1 is obviously to come up with a workout strategy, but just as importantly, it's to come up with an opportunity to interact with the client. Phone calls, face-to-face meetings, they're sending in information, because at the end of that time, you have to have built up a rapport where the client has that intuitive sense that this makes sense and I trust you to go forward. Because phase 2 with us is where we negotiate on their behalf. And what generally happens in that 3 to 4 weeks when we're going through in phase 1, we're going to discover some things through due diligence that require extra due diligence when we go into phase 2, because we're looking for those leverage points, as I said. And then in phase 2, we'll do the extra due diligence, and then we send the bank what we call our 50-pound letter. It's our setup letter, and we tell them what we've found, what we intend to do, and what the consequences will be if we don't get cooperation. And it's friendly. I mean, we don't start out with a baseball bat, and there's a lot of occasions where we're able to negotiate it all the way through and remain on a relatively friendly basis. But of course, there are many occasions where the lender thinks they can roll right over us. And then we send them that letter, and then we have to up the ante as we go down the road. And so that puts the bank on notice. And so that's our methodology. And there's lots more that I could share with you. We're happy to meet you and to talk about it in more detail, meet you at lunch or this afternoon. But I'll leave you with this, that we think that there's a great opportunity for you if you have an investment yourself that has gone south, that we could chat about that. But if you're a broker, or you don't even have to be a broker, if you know people that are in trouble, you simply refer them to us, and we can be a resource